Thank you for joining us today for free From Simple to Sophisticated Small Business Retirement Plans. Today is March 28th to 2024, and you are here with the San Pablo EDC. A few housekeeping items. The webinar is being recorded. A recording will be available on our website at www.sanpabloedc.org. Any resources mentioned during this presentation will be available on our website. All attendees are muted. If you have any issues with audio, you may need to click on the webinar screen to enable audio. We welcome your questions. Please type them in the Q and answer box. We'll answer them at the end of the webinar when time permits. A little bit about the San Pablo EDC. The mission of San Pablo Economic Development Corporation is to act as a catalyst for equitable economic opportunity. The programs and services that we support are employment training and support, home ownership, business resources, and access to capital. Now we'll be turning over our screen to Mr. Mark Porter with Ameriprise Financial, who is a certified financial advisor.
Hello, everyone. Welcome to our workshop today. I'm really excited to share with you information about different types of retirement plans. Oh, I think I'm not on the right screen. Hold on just 1 second. Share. Let's try that one. That's not the one I want to share. This one. Okay. Hold on a second here. Let me get regrouped. For some reason, I'm not sharing the one I want to share. From the beginning. Good. Share. There we go. Okay. Sorry about that. So we can see our screen now. There we go. Very good. So we're going to talk about small business retirement plans from simple, which is actually the name of a retirement plan, to sophisticated, which would be a cash balance plan or a defined benefit pension plan. Starting off a little bit about the statistics of small businesses, a lot of people don't really realize it, but that's a major segment of the economy. 99.9% of all U.S. businesses employ 500 or fewer people. So yes, there are some large companies out there and they do employ a lot of people, but most of the businesses, when you count them, and as far as how many businesses there are, most of them are 500 or less employees. Something to think about there. Also, a little less than half of the private sector employees are then employed by these small businesses. So that means that about 54% work for large companies like Microsoft, but 46% of all private sector employees work for these small businesses. So there's a lot of ways small businesses can benefit themselves with retirement plans. 63% of the small and mid-sized employers offer a retirement plan that's 25 to 49 employees. We're going to talk today about retirement plans that are great for one person, and we're going to talk about some plans that are great for maybe 50 employees or more, and also a few plans that are great for 500 employees or more. So we'll talk about all of it. Depending on what you're trying to accomplish, we will hopefully find the right plan for you, right? So the advantages of the employer-sponsored plan is you've got tax-deductible contributions going into the plan, and it allows you to let all of those people you're interviewing know that you do have a retirement plan. It allows you to hopefully retain some top talent. And also, as the owner of the business, you are able to put away money untaxed from the company's account into your very own retirement account for yourself, which is great. There are some costs to manage the plan. Over the years, the cost for managing a retirement plan has come down quite a bit. We can usually get a single person 401k plan taken care of for about $800 or so a year. If you have 20 employees, we might have to pay $3,000 or something like that per year for that plan, but the costs are really, really low compared to what they were previously. Then we have the plan participant, the employee. The advantages of having participation in the plan for the employee is that old element of the three-legged stool for retirement planning, having three sources of income where Social Security is only one of those sources. Also, deferral opportunities, basically tax deductible employee contributions into the plan. So they pay no tax this year and they only pay tax when they remove it. Also, they could get a match if the employer has a match program. Perhaps they put in 3% of their annual payroll and the employer will put in 3% of that annual payroll number as well to give them a leg up for retirement. Also, another advantage not listed here is now there are Roth 401k contributions allowed. So that's great. You pay tax on the money now. It goes in the 401k plan. It grows tax deferred. And if you follow the rules, you can withdraw the money federal and state tax free. And the employees who have access to a retirement plan tend to be happier than those employees who don't. Some of the disadvantages for the employer-sponsored plans, which are thankfully not very large, limited selection of investment funds. Many of these plans have about 20 or 30 mutual funds that you can choose from, which is quite honestly enough for most people. You'll have some small caps and mid caps and large cap stock funds. You'll have some government and some corporate bond funds. There'll be a real estate fund and a money market fund and a principal preservation fund and maybe an international fund. And, you know, for what most people are doing, those are fairly good choices. The participants in smaller plans will pay a little bit higher for the fees, and the fees are very low in the larger plan. So you do want to use the plan yourself and also encourage the employees to do so. For today, we'll talk about IRA-based plans. The most common IRA-based plan is the SEP IRA plan. Not very many people use the simple IRA plan anymore, but we do have some smaller companies where the simple IRA plan makes sense, and they've looked at a 401k and they've looked at a cash balance and they say, hey, that's not for me. I want to do the simple IRA plan. So we're glad to help with that. Also, when we're looking at qualified retirement plans, defined contribution plan is another name for 401k, 403b if you're a school or religious institution, 457 plan if you're a city or municipality, 401a if you're a college or something like that. And then we have defined benefit plans, and this is the technical term for a pension. And yes, you can have a pension for your company. One employee or 3,000 employees, you can have a pension. We help companies establish pensions all the time. If that makes sense for you and your business, it's certainly worth looking into. So with IRA-based plans, the most common is the SEP plan. This plan only uses money from the employer. The employee is not allowed to contribute to the SEP plan. Some people prefer that, so they're not dealing with employees' money. If you want employees to be able to put in some of their own money on a tax deductible basis, then that would be the simple savings incentive match plan for employees. It's a simple IRA where the company puts in some money and the employees can put in some money as well. So with the SEP plan, SEP, and the simple, there's no record keeper necessary. That means you save about $2,000 a year by not having to hire a record keeper for the plan. The government reporting is a lot simpler with these plans. There's only one report per year. How much money did you put in, and for who did you put that money in for? And that's pretty easy. Also, should an employee terminate employment with these kinds of plans, it's very, very easy for them to move these plans into a new employer plan or to move this plan into a traditional IRA. So the portability and accessibility is a lot nicer. There's no ERISA bonding requirements. ERISA is a law that was put in place regarding the fiduciary responsibility of the employer to behave and do good with the employee's money and that sort of thing. And because the employees have control over these accounts themselves, the owner doesn't have to buy a bond for the ERISA requirement. For eligibility requirements, this is a thing for companies with high turnover. If you have many employees that only work there for 3 or 6 months, you might want to exclude them and say, hey, you cannot participate unless you've worked here for at least a year, right? So that's something you can do with an SEP plan. And you also have reduced fiduciary liability for the investments, because here again, with both of these plans, the employee is picking their own mutual funds. You are not, as the employer, responsible for providing them with a list or anything like that, right? But there are some disadvantages with these plans. The contribution limits for the owner and also for the employee is a lot less than the other kinds of plans that are available. So you'll be able to put in less money. The allocation formulas are limited as well. With a 401k plan, you'll be able to allocate more money to the people that you want to. There is not very much creditor protection on the SEP and the simple plans, meaning for bankruptcy protection or for you being sued for whatever's going on or what have you, the protection of the IRA-based plans is not as strong as it might be if you were doing a defined contribution plan. So the SEP IRA, basically there's a maximum employer contribution of 25% of the compensation of the employee. And so whatever you're doing for one person, you have to do it for all of them. You might say, hey, we had a really good year. I'm going to give every employee 5% of their payroll contribution to their SEP IRA, right? The maximum contribution for last year would be $66,000. So what that means is that you can only put away $66,000 maximum, right? But in order to do that, the income for the business would have to be $264,000. 25% of that is $66,000. So this might be someone like a realtor or maybe a independent attorney, someone who's self-employed, and they want to put away 25% of their $264,000 compensation for themselves. They have no employees. That's kind of a way that would be done. Or possibly let's just say they have a business with $1 million of revenue. They can allocate 25% of the compensation out to several different employees, including themselves. They just have to give everyone the same percentage. So it's got to be established by the tax filing date. And this is a key benefit of the SEP IRA. you can establish and deposit money in this plan for 2023 all the way until October 15th of this year. And so it's retroactive if you were to put a plan in place now. That's not the same with the other plans, but with the SEP IRA, you can do that. One disadvantage that's big for me, you cannot borrow against the plan to buy a house or cover an emergency situation or things like that. That's really a bummer because I personally borrowed money from my retirement plan to buy my first house, and a lot of people want to do that. So that's a big disadvantage here. Also, there's no vesting. So once you put money in a SEP IRA for one of your employees, that day, that money belongs to them. You cannot tell them they have to work for you for 5 years or 4 years or 3 years in order to have that money. The day the money goes in the account, it belongs to them. So there is no vesting formula there. And the government reporting is really very simple. How much money did you put away and for who? So age requirements, 21. Employment requirement, you can say they have to have worked 3 out of the past 5 years. The minimum compensation requirement is $750 per year for 2023. If they made less than that, then they would not be participating. You can exclude collectively bargained employees. We don't have a lot of those around here per se. Most of those companies are really, really large. But if you did have them at your business, you could exclude them. And the business owner is subject to the same rules as the employees, right? So think of it this way. You have an employer's SEP plan, and everybody gets money from the company. On the far left, you've got the employer's SEP IRA. So you, the owner, have a SEP IRA established for your retirement. And then each of the employees also have a SEP IRA that money goes into for their retirement. So we put in a generic boilerplate SEP IRA plan document. We can pull that off for free. And each participant would establish their own SEP IRA. And we try to keep those all at the same place because it makes it easier for you and your payroll department to get the money in there. Technically, the one employee could have an account at Mechanics Bank, and one employee could have an account at Schwab, and another employee could have an account at Fidelity, and then another one at Ameriprise, and then you're cutting these checks every 2 weeks, which is kind of a mess. So when that's going on, most people will cut a check to the SEP IRA once per year. On about October 10th, they will fund it for the previous year if there's a bunch of accounts there. But if they have all the accounts in the same place, it makes it a lot easier for payroll, especially. The simple IRA is interesting. It's kind of leaning more towards a 401k plan where the employee can put away in 2023 of their own money on a pre-tax basis, $15,500. The employer can do a match of their contribution or a non-elective, meaning they're just going to put money in there as they have it and when they feel like it. The administrative costs on operating a simple IRA are very minimal. Catch-up contributions for people that are over the age of 50, like myself, $3,500. That's coming from the employee paycheck. Limited fiduciary liability for the business here because the employees are checking out their own funds. They're choosing their own investments. And the deadline to establish this one is October 1st of that year. So you can't really go backwards on this plan. That's because the employees have to have a chance to put money in throughout the year. So one way of doing this contribution, you can do 100% of the match, up to 3% of the compensation for the employee group. You can reduce that if you have a lousy year or two. You can reduce that 2 out of 5 years to 1%. I definitely tell people if you do not see yourself putting in 3% of payroll every year, this could be a tricky plan to have because you really need to think about having that money available, right? Another method is just giving every employee 2% of their payroll for eligible employees, and then you're never changing it. It's just always going to be 2%, but that means you only get 2% as well. So looking at the employer's simple IRA, you've got the employer's money going in. You have the employees' money that can go in, and there is a match from the employer into the account. And the document would explain it to everybody so they understand what's going on. But the employees are supposed to establish a simple IRA with their favorite financial institution. Normally, if you were to choose to do a simple IRA, we would work with you and your employees to establish all of the accounts in one place. It makes a lot more sense that way. Here's an example of the differences for a business. And this is where somebody comes in and says, hey, Mark, we're thinking about doing something. You know, what does it look like if we do an IRA-based plan? And so in this example, the employer or the owner, in this case, is Andrew, who pays himself $50,000. If he did a SEP IRA, the business would put 10 grand in his account and $4,000 in each of the employees. And so the employer is putting in 22 grand and the employees are putting in nothing. They're not allowed to. Employees cannot contribute to the SEP IRA. Now, there's a different way of doing this here. With the simple IRA, in this case, Andrew would defer $8,500 of his own payroll money, and each of the employees would defer $600 a year of their own payroll money. And then the company would match the employees dollar for dollar. And Andrew only gets a $1,500 match because he can only get 3% of the payroll of 50 grand, right? So in this case, the company is contributing $11,800. The employees are contributing $1,800, but the owner is getting the same amount of money, but not having to contribute so much money towards the employees. So it depends on your goal. You know, do you want to give the employees $4,000 a year in their plan, or do you want to give them $600 a year in their plan? The owner is getting the same amount of money here. They're getting $10,000 in either example. So that's one way of looking at it. What is the goal of the owner of the business? So then we move on to qualified plans. It's a fancy word for 401k, really. There's defined contribution plans, 401k plans, right? And then there's defined benefit plans, and those are basically pensions. The Internal Revenue Code section 401A is what allows these plans to exist. They definitely cost more to administer than the IRA-based plans. Some of these plans are thousands and thousands of dollars to use. I believe the minimum administrative cost, if you want to use Fidelity as a vendor, is about $10,000 per year. That's their minimum cost. So if you have a small plan and you're not going to put a lot of money into it, 401k plan, then the Fidelity plan might be a little more expensive than what you're going to really benefit from. The reason why people use 401k and defined benefit plans, many reasons are bankruptcy protection, creditor protection, and you can put a lot more money in. The employees can put more money in, the owner can put more money in, and the company can provide a much larger match with one of these two plans than with the IRA-based plans, right? So 401ks are really, really the most popular defined contribution plan. There are 60 million people in the United States as of 2022 that have a 401k plan of some kind. $6.3 trillion in assets, mainly held in mutual funds and in some cases company stock. They're sponsored by employers of all sizes. We have single individual businesses that have 401ks. And at one time, I worked on the United Healthcare 401k. Thousands and thousands of employees in that 401k. The costs have been coming down because a lot of this is done by software now. We don't have to pay a actuary in the basement with a calculator to figure things out. The software is reducing the cost for these plans a lot, so they're becoming really popular. Some of the advantages of the 401k plan. For last year, if you were 49 years old or less, you could put away $22,500 into your tax-deductible 401k or into your Roth 401k or a combination of the two, right? And then the employer, which could be you or it could be somebody else who owns the business, they can do a discretionary profit sharing percentage of your pay. So if you were so fortunate to make $100,000 a year and they're doing a discretionary match of 3%, well, there you go, $3,000 in the plan, and that's great. So the limit of those two can be $66,000 for last year. Remember, that was the same as the SEP IRA. But different with this plan, with the 401k plan, people that are my age, 50 years or older, can do an additional salary deferral pre-tax of $7,500 or Roth of $7,500. And I think that's great. That's definitely a nice amount of money if you have the money to do it and you have not put away as much money as you should have when you're younger. This gives you a chance to do more. Of course, 401ks allow loans. Generally speaking, you can borrow money for any purpose and pay yourself back. You're borrowing against your own money. The interest you pay on the loan goes into the account. It does not go anywhere else. Also, the interest rate is the prime interest rate plus a small margin of maybe 0.5%. So the interest rate is generally speaking quite low. You can provide a vesting formula as long as 5 years. The employee has to work for you for 5 years before they have any of the matching money that's theirs. So if they work there, if you did a 5-year vesting schedule, if they work there for 4 years and 364 days, they would not be able to take any of the matching money the employer deposited. They would have to work there for 5 years or they get none of the matching money. So rewarding people for staying with you longer is kind of what that's called. And of course, the Roth 401k deferral option, which is not available in the SEP or the simple IRA, is a big component since 2010 of the 401k plan. Now, no matter how much money the no matter how much money the employee earns, they can put money into the Roth 401k. There was limits on contributions for Roth IRAs. There still is, but it doesn't matter how much the employee earns. There is no limit on them being able to contribute to the Roth 401k. I love some tax-free money in retirement, right? Some disadvantages, thankfully they're quite small. Really, there's maintaining and monitoring the 401k. You really should be able to devote at least an hour a quarter to checking in with the administrator for the plan. And then, of course, there's administrative fees. You don't have those with IRA, SEP, simple plans. But with a 401k, there is administrative fees. So that is a disadvantage. You got to pay money for it. Some disadvantages for the participants, additional fees. They're not allowed to buy stocks directly in most plans. They have to buy mutual funds, and of course, mutual funds have some operational costs. Most 401k plans have limited investment options, meaning there's not a million investment choices. In many cases, there's about 30 investment choices in 401k plans, which I think is good enough for most people. Restrictions on money. The employee can only deposit money in the plan from their wages. They cannot use money that their sister paid them back. They cannot use gifts from grandma. None of that money can go in there. For 401k plans, it's got to come through payroll. Okay, so that is a disadvantage for some people. Maybe they didn't have a lot of money in the beginning of the year, and towards the end of the year, they had a little more money. They have to basically contribute 100% of their paycheck to get it in, because you can't just write a check or transfer money into a 401k. It's got to come from payroll. Some challenges with 401k plans is that there are some discrimination testing, and this is put in place to protect the rank and file employees. We do not want these 401k plans to over benefit the owner. Okay, it's not fair. The IRS doesn't like that. So there's an average deferral percentage test. If your deferral percentage is low, then they might send the highly compensated employees some of their money back. Your money could actually get evicted from the plan if not enough people are participating. There's an actual contribution percentage of payroll. If there's not a high enough actual contribution percentage, some of the highly compensated people and or owner could have some of their money evicted from the plan. Minimum coverage, and then top heavy. If the plan has a large amount of money from the owners and highly compensated employees, that causes a problem. So there are ways to bypass these problems by matching the employees. So it's not normally a problem for most people, but this kind of takes a look at the rules here when you've got the deferral rate of 12% on the top of non highly compensated employees. The highly compensated employees' payroll cannot exceed 15% of the deferral rate. So we just have to be careful that we are providing the employees with education about the plan, what it is, what it's not. Give them the safe harbor match of 3 or 4%, and usually we can pass all of these rules pretty good. Designing the plan to meet the minimum employer funding level is a good idea. It will increase the funding costs, but it will lower the administrative costs and also enable higher deferrals for the owners and the higher paid employees. So it doesn't cost that much to provide a profit sharing or match for the lower paid employees. And by doing that, you allow your higher paid employees who may have the ability to save more to use the plan really well. So some allocations, there's pro rata, where you do an allocation of all the participants of the same percentage. There's age weighted, where the older people that work there get a higher percentage. There's integrated, where the higher paid participants get a larger percentage. That one's a little tricky. It's hard to pull that off all the time. We'd like to do the new comparability, which is a little more time consuming, involves a few more Excel spreadsheets. But with the new comparability, which was a new rule that was passed, we can oftentimes help the employer come out with a good balance of contributing to everybody. So this slide is really busy, but the main thing I want you to see here is we have an owner that's 56, an owner that's 51, and they pull about $610,000 out of the business. So think of two partners or two spouses or two people that just opened up a business. And so this is kind of where they are. And they have some employees that are working there that are their age. They might be working part-time, or they might not be doing a lot of important work, so their wage is a lot lower. And then they have some younger people there. And so the idea here is, how do we get as much money? The owners are going to ask me this, they always do. How do we get as much money into the employer's plan without over contributing in the employer's mind to the employees? So this is what we show them. And we basically say, okay, from here, you can see what the owners are getting and what the employees are getting. A lot of times we find that they will end up choosing integrated, even though they're contributing more money to the employees. It just feels better. For only 10 grand more in total cost, you can get more money into the employees, and 135,000 for the owners is the same on the integrated and the new comparability. So how much do they want to put in for the employees? And they want to look like a nice person. The employees never see any of this data. It's something that we talk to the owner about and the CPA. So we talked a lot about retirement plans and that sort of thing. For people with no employees, there's a lot of advantages with the SEP and simple plans with the higher contribution rates and that sort of thing. They will eventually be able to get loans and Roth deferrals on those. A lot of the plans have not installed that yet. Cost savings for multi-participant 401k plans. We can sometimes cover somebody if they have 3 businesses with the same 401k plan, and that will be helpful for the discrimination testing and that sort of thing. So an example with the 401k plan versus the SEP plan and the simple plan. And in this example, we're really talking about probably one individual person owning this. Think about an independent real estate agent or an independent real estate appraiser or an independent attorney or what have you. With the individual 401k plan, they can put away 25,000 for the match, if you will, and 22,500, okay, for a total of $47,500 deducted from their tax return, right? However, if you're using a SEP IRA, you can only put in 25,000 for yourself. And if you're using a simple IRA, you can only put in 3,000 for yourself, and then from the company, 15,500 from your own wage. So you got a total of 18,500 there. So if you are an individual person with a business, sole proprietor, S Corp, C Corp, LLC, I don't care, they're all the same. You can have an individual 401k for yourself, and you could deduct $47,500 from your tax returns if you have the money. If you're making 100,000 a year, you could do that. And sometimes we meet people that have done pretty well for themselves and have not saved a lot of money for retirement, 49 years old, and they're paying themselves 100,000 and they can live on smaller amounts of money. An individual 401k might be the way to go for them, right? So who would benefit from the individual 401k plan? Really, the people who want to put away more, that's for sure. But also who would benefit from the defined benefit plan? This is the pension, okay? A private pension. We can do that. We can have a pension for a single person, as long as you can fund it. Some of these pension plans, you can deduct $130,000 from your income tax. We had some kind of independent doctor of some kind that basically did independent doctoring for different medical groups and that sort of thing. And they had a $700,000 income, and we were able to put away $130,000 deductible into a defined benefit plan, which is really a pension. There's another one called a cash balance defined benefit plan. where you can put in a little bit less money and it's a little bit more expensive to operate. And we normally will do a cash balance defined benefit plan when someone has a 401k plan and they still want to put away more money. They're fortunate enough to want to put away more money. So here's the cash balance plan compared to the regular plan. And here what we're seeing is with the new comparability and the cash balance plan, the allocation for Karen and Frank is significantly higher. You see their allocation of what they're putting away for themselves is a lot more money than if they were doing the profit sharing plan only. So if their business could fund large amounts of money for their retirement, they're able to do the new comparability formula with a cash balance plan. And basically they're putting almost their entire compensation. Karen's making 305 and she's putting 301,117 in the pension plan, right? Because maybe she can do that. She has money from other sources and she's behind on retirement. So there's a couple of ways of doing that. When we think about cash balance plans, it's not dependent on employee contributions at all. Cash balance plans are 100% employer contributions. Employees are not allowed to contribute. The contribution limits are much higher than a 401k plan, as we saw, $301,000. The contribution plans are higher than SEP plans and simple plans and that sort of thing. And it's what they call a above the line deduction, which a lot of people appreciate. And it's based on an annuity payout plan. People don't always do that. But basically what happens is when people hit 65, they choose a monthly payout for the rest of their life, or they choose to roll it out into their IRA, and then they can just withdraw money when they want to. So that's kind of how those tend to work. There's an insurance company behind the scenes that you pay a premium to in case the employer screws up or absconds with the money or what have you. There is insurance on the plan, so that way the employees can feel that there's protection there. So the people that benefit from the cash balance plan the most are people that are really doing well with sales in their business. The cash flow is really, really good. We saw Karen making $305,000, and she's having that $301,000 going into the plan, which is, you know, she's left with like $3,000 of income from the company, but she might be behind on retirement and has money to pay her bills from some other source. And so it's cash balance plans are normally companies or business owners that have 401k plans and they have been fully funding them for quite a while, and they just want to put away more money. I usually see as people approach 60 years old, they get more interested in the cash balance plans. Now, we have some people at the age of 40 that have them as well. Not very common. The formula works so much better the older that you are. But that's it for my presentation today. I would like to invite everybody here to ask any questions if you have them. I don't know if we have the chat on, but if you want to unmute yourself and ask questions, we'll follow up with a slide deck of this presentation and a few other items that might be helpful. But we're always available to talk to you about what's important to you and figure out what kind of vendor that you might need, payroll, 401ks, if you're a nonprofit, 403bs maybe, and that sort of thing. And just figuring out, number one, what do you want? If you're the owner of this business, what do you want this plan to accomplish, right? We think that's the most important thing. And then also from there, what is the money that you're going to be able to use to fund the plan, right? That's really important that we figure out how long can you fund the plan and how likely is that to happen. You can't really, once you get a 401k going and you provide the employees with a match, you really can't do a lot of changes. You can, but with the cash balance and defined benefit plans, it's really a hard time to make changes to those. You would have to terminate the plan, and that the IRS doesn't like that. They like to see the plan open for at least 4 or 5 years. And so we tell people, you know, if you don't see yourself being able to fund the cash balance plan or the defined benefit plan moving forward for at least 4 or 5 years, you don't want to end up terminating the plan and then failing an audit, because the IRS might be concerned that you're just trying to get one over on them, and it's not really a long-term retirement plan, right? So there's a lot of things to consider with these kinds of plans. You want to make sure you have a buy-in from the owners. All of the owners should really think this is a good idea. Talk to your tax professional, possibly about their opinion. I'm usually the new person on the scene, and the tax professional has known the client for a long time. And I have found out I come up with 8 proposals, and the CPA only approves of 1. So I've spent 5 hours coming up with these proposals, and so now I've learned talking to the CPA first about what is likely, what are the goals of the account, and that sort of thing. But does anyone have any questions for me today for today's workshop?
If someone does have a question, please put it in the question and answer box. I'll give it a minute.
Starting to rain over here in El Sobrante.
Okay. I have a question for you, Mark. Here in the San Pablo region, we tend to have businesses with less than 5 employees. What would you say is the most simplest plan that you recommend for an owner with about 5 employees? And why?
Well, yeah, that we normally have to ask more questions with that, because in my opinion, they're all really simple. I mean, the employer or the owner tells me what they want, and then everyone else, the CPA, the actuary, the third-party administrator, the financial advisor, we do all the paperwork and we make sure the plan goes. So in that respect, they're all pretty simple. We really normally want to figure out, based on how much money the owner is looking to contribute to the employees and or themselves. I just kind of base our advice normally on, okay, how much do you want to put away for yourself? How much are you comfortable in matching the employee's contribution? So we have some 5-person places, let's just say a donut shop. We've got the owner and 4 employees at the donut shop. The employees are very temporary a lot of times in those situations. In other situations, they've had the same person doing donut cooking 3 days a week forever, right? And so that employee is a long-term employee. They make enough money to put away the money. For them, a simple or a SEP IRA would basically cost the employer no money for administration fees or anything like that. We would cover all of that. We would provide a plan document from the IRS for free, and they would just start putting in money. But in the SEP plan, they're employer money only. The simple plan is a little nicer because the employees can put in some of their own money if they want to, and that's great. But if the employer has quite a bit of money they want to put away, the only way to really do that is the 401k plan. And then that goes for a little while. And then eventually, as the business is more successful, even with 5 employees, they might have a little engineering firm where the owner makes 200 or 300 a year and the other employees make 50 or 60 a year. I've seen that here in San Pablo. There's a lot of engineering firms over here, and they say, hey, Mark, I can't put enough away in the 401k. What do I do? Okay, we have to add a cash balance plan to that, or we have to add the defined benefit pension plan. So the question is really simplicity. They can all be really, really simple because the employer, the owner, is not doing the work anymore. There's really, we have to outsource that. It's like people that are doing their own payroll. I say, gosh, the risk of you messing up the payroll and the fees for doing so is more dangerous than the cost it is to have a payroll company. It's just so worth it. So how much money do they want to put away, and the age of their employees and their annual payroll? I toss that into my software, and then we come back with the cost for that plan, and then we can talk to the employer or the owner about which plan looks better. And you saw some of the things today on how much they can put away and what the costs are, right? So I see a question here from one of my favorite bankers over there in the San Pablo Center next to La Strada. Can employers borrow from the company's 401k for whatever reason? They can borrow from their own money in the 401k for their own purposes, whether it be private or company needs. And another reason why we recommend 401ks for people, if they have 100,000 in the 401k, the business owner or the employee can borrow $50,000 and pay it back over 5 years at prime interest rate plus half a point, which is great. Some 401k plans have the provision that if you're buying a house for you to live in, you pay the loan back over 30 years. Oh my gosh, I don't even care if you need money from your 401k to buy the house or not. We normally tell people, go ahead and take the loan in case there's some kind of calamity that comes up being a new homeowner. Of course, with ADUs being all the rage and that sort of thing. And if you are in the house for a year or something like that, and you say, oh gosh, I really don't need this money and blah, blah, blah. Well, then fine. Pay 100% of the money back. I have done it myself. I've borrowed money to buy real estate. Turns out I didn't need it, or I didn't need all of it. And then I paid it all back quite quickly. But the employer can only borrow from their own funds, and same thing with the employee. They can only borrow from their own funds that are in the plan, right? That's a great question. The 401k loan provisions are a big reason to really provide that, because sometimes for people that don't have a house yet, their retirement savings could be their largest one. And many times we encourage people that are coming to work at a new employer who has a 401k plan to consider consolidating their old 401ks or their old IRAs or their old Roth IRAs into the new plan, because it's easier for the employee to monitor the investments when things are in the new plan. And also, if there is an emergency or a crisis that happens, it takes about 10 days to borrow from the 401k plan at your current employer. You cannot borrow from IRAs, SEP IRAs, or 401ks at previous employers. So why the heck have that money over there? Put it in a place where it's invested fine, and give yourself the ability to borrow from that money in case there's an opportunity, which I love, and also in case there's a crisis, which I don't care about having crises. But if you can borrow money from your 401k plan for a crisis, the crisis will seem a lot smaller, right? Great question.
Is there any more questions? Would anyone else like to ask a question? If not, I'll be sharing Mark's contact information on the screen, and you can take a screenshot of it using your phone or your computer. If you are on your phone, then take a screenshot.
Everyone here knows how to find me. I'm either at table 10 at La Strada, Tuesday, Wednesday, and Friday, or you can type in my name into the internet. But yeah, that is my cell phone. Feel free to give me a text or a call. We're a little busier than usual from now until April 15th with tax season, but we're here to help each other, so let's figure out a way that I can help you and let me know what kind of business you operate in case we have somebody that we talk to. We're talking to lots of people in San Pablo and West Contra Costa County all the time, and they're doing all kinds of stuff. They need to buy a van for their business, or they need to buy an oven for their pizza place so they can make twice as many pizzas. And these business owners are doing lots of great, amazing stuff, and we want to have the resources to help them out. And I think we're really lucky that we've got a company like San Pablo EDC. Their whole goal is economic development, and they're providing all these resources. And we are a community of people that is here to help the entrepreneurs and the business owners do more of what they want, better, faster, and more efficiently, right? And that's the name of the game with the EDC, is helping these entrepreneurs provide more jobs for our San Pablo people, right? Well, I've had fun, everybody.
Thank you, Mark, and thank you for everyone who joined today. Have a good evening.
All right, bye.